We are live with the macro market report, and so it's me, Kashyap, and Kevin is joining us today, which is awesome. Trying to just kind of talk about some interesting things that have come up over the last week, and it's around news, the Fed, rate cuts. Let's start with what happened today. What happened today in the market, guys? Let's start there. Kevin or Kashyap, either one who wants to answer that.
I can go. Look, so all right. So what happened in the equity market today, as far as the E-mini S&P 500, we saw a lot of reaction, or pretty volatile reaction, when it came to the jobs report this morning. Now, what I will say is that I believe that it was a mixed report, to say the least. Like, if you're a reflationary bull right now, you had something in there. If you are a Goldilocks scenario type of person, there was something in there for you. If you were in the camp of the Fed's on a rock and a hard place and it's only going to get worse, there was something in there for you. So the market took a lot of time being able to try to digest the data that was coming out. Now, let me just go high level what that data is for those that may not have watched it this morning. Average hourly earnings is the first one that I'll kick off with, because that's your inflationary gauge. And really, when you're looking at that number, think about that number coming in on the services side, because then services are 70% of our economy, 75%, depending on the quarter, right? So you're keeping your eye out on that gauge. And if you want inflation to come down, you want to see wages also starting to decelerate at a pretty healthy clip, because the majority of the stickiness of inflation right now is coming from wage growth, and then it's also coming from shelter, which we just can't seem to tame that right now. I won't even go on that side. We've had that conversation when it comes to the shelter component. But if you're looking at the year-over-year number, which I don't really follow that much, but for those that really do, that came in at 4.1%. Estimate was 3.9%. We also had a revision of last month for 4%, and that was revised up from 3.9%. So wages going in the wrong direction if you want inflation to come down, right? That's your reflationary trade. If you're a reflationary bull, you like to see that number. Higher inflation, in a sense, higher commodity prices, and then in some respects, actually higher equity prices, depending on the environment that we're in. We also then had non-farm payrolls that just smashed the street's expectations, and that's what it's been doing over the last 2 years. But last month, we had a rapid deceleration to 175,000 jobs, which was actually reported, and that was coming down from 330,000 jobs, right? So that rate of change was a cause of concern and brought in the stagflationary narrative that people have been kind of spewing over the last couple of, let's say last month or so, right? But we had a decent rebound in non-farm payrolls, beating the street's expectations. But if you go back to the revision of last month, remember I said 175 was actually a very low number, shocked the street. They revised it down another 10,000 jobs to 165,000. So soft landing narrative type of person, you would say, hey, job market's still looking very robust. Let me tell you this, though, real quick. That's all part-time job growth. In full-time jobs, we actually had net losses, a significant amount of net losses. So part-time job growth, this is in-cycle behavior when you're looking at the labor market. Part-time jobs are the ones that are going to be the most volatile and the quickest to be able to stop, right? So we had that. And then the last thing, putting the Fed in the rock in a hard place, unemployment goes up to 4%. Not surprising. On a relative basis, guys, and you guys know this, 4% is not bad. That's not a bad unemployment number at all, historically, if you're able to maintain around that average, right? But the rate of change going from we were at 3.7%, 3.6% on our low, going to 4%, that rate of change is what to be a little bit of a cause for concern. Here's the thing that puts the Fed in the rock and a hard place, though. The Fed's summary of economic projections, their target for end of year 2024 is 4%. Now, we have a Fed meeting next week. We have a summary of economic projections coming out next week. Do they move that target up? They most likely will. If they move that target up, how will the market perceive that? Is the Fed kind of bracing and giving a little bit more credence to a economic slowdown or a recession? What is that going to entail when it comes to their PCE projections, things of that nature? So that's the report. I'll kick it back because I brought a lot in. But every single segment in some way, shape, or form gave some optimism, no matter if you're a bull in the equity market, if you're a bear in the equity market, if you're a bull in the commodity space, or if you're a bear in the commodity space. It just depends on the dynamics of how it's going to affect policy moving forward.
No, great. And that's part of the reason why I asked that question, because I figured Kevin had all the numbers and would have a much better answer than any of us would. So great job on that. But really, I think something that's important to talk about, which is the way the market perceives things. Like it's to this morning, the market perceived this as the Fed would not cut rates anymore. Like just for this morning, not saying that that's off the table at all, but that's also what some of the media ran with. Some of the media also ran with the idea that traders are betting that there will no longer be rate cuts. This is the end of the bull market, the end of everything, and they start to get into this idea that this is going to end, and then people are going to look at it and go, okay, well then, therefore this is why the market came down this morning. It's like, it's already back up. If you look at stocks, they're already back positive. I don't know if they're positive right this second. I'm not looking at it right this second.
Yeah, they are.
They are. Okay. Yeah. Stocks are getting back to positive. They're all, if they're down, they're barely down. I mean, it still looks very good and constructive. The things that took a big hit though are the commodities. The commodities are down quite a bit. Silver down over 5% today. Gold's down 2.5%. Oil is actually up though, and oil been getting the crap beat out of it, so it's kind of bouncing up right now a bit. But a lot of the commodities across the board are just taking a hit, and the dollar's catching a nice bit. All the way from, it came from what? It's almost up to 105 now. Yeah, 104.87. So. We have if you kind of look across the macro space, you're seeing that the market is tilting for this environment that's looking kind of like Goldilocks and so on. However, you can't look at the market in a one-day move and go, this is exactly what the market is thinking. You have to look at it in a big picture way. If you look at it in a big picture way and go, okay, so most likely, let's talk about something, and Kashyap and I were talking about this earlier. All these central banks right now are cutting. I can't remember them all off the top of my head. I know it's the Bank of Canada. What are the other ones? You guys remember them? ECB cut that was yesterday, right?
Yeah.
So ECB cut yesterday. I know another central bank cut too. So it's like, if we look at it that way, most of the time, and it's kind of why when people are talking, it's actually funny because there's always been a lot of speculation about one world currency and stuff, and from people who are religious, from people who are conspiracy minded, whatever it is. There's a bunch of people who believe that's going to happen. And the one reason why that would be
sorry, for what? A one world currency?
One world currency, yeah. People always talk about it like,
that rabbit hole.
I'm getting to a point here.
Let's go.
not talking about the one world currency here, but just getting to a point. And the only thing that's actually the only reason why it ever makes any sense when anybody says it, it's most likely untrue, because there would be so many things that would have to come into it. But the one thing that the central banks would love is to all inflate and deflate at the same time. They all tend to really run behind another one. If everybody's cutting, the Fed's not going to start hiking. If the Fed starts hiking, everybody else is not going to start cutting. That's usually how it goes. So I'm kind of looking at it and just going why I'm saying that is because they kind of all go in tandem. That's my point of even bringing that up. They kind of go in tandem. So as we're kind of seeing everything move that direction and everybody's putting out these rate cuts, I do think that the Fed's still going to cut, and the rate cut probabilities. And even though headlines like that are coming out, we're still seeing traders add bets that the Fed will skip interest rate cuts this year. Even though headlines like that are coming out, we're still at a point where nothing looks off the table. The rate cut probabilities are still pretty high. They're still leaning to rate cuts this year at some point. So I don't think the one report this morning, especially if you dig into the report like Kevin has and talk about the things inside of it, and Kashyap and I were talking about this earlier, all the jobs that are coming out are part-time jobs. They're not, people aren't getting hired at crazy rates. And if you have friends, family, people who make good money, you talk to them about their job market, most of them are going to tell you, especially in the United States, that they're not getting job offers right now. They're not getting offers to move up. They're not getting offers to be full-time. A lot of those things just aren't happening right now. But there is a lot of need for low-level positions at the moment. because nobody wants to do that, because nobody can afford to live off of them at the moment. So it's a catch-22. So it's going to be quite interesting to see how that all goes moving forward. But
So
anything
sometimes,
to add on that, guys?
yeah. So I think sometimes the market just gets these news-driven reactions plain wrong. So if you remember, end of last month, we had this scary headline of Treasury bond auctions are failing, so sell bonds. And then you had a classic V bottom in bonds, and it came right back up. And now with this payroll number, it's the same thing. You have this crazy sell off in bonds, you have this crazy sell off in commodities, and odds are next week is just going to be straight up again. And it's just because, like Kevin pointed out, these numbers get revised all the time, and broadly, they are not that meaningful. Like they really aren't. Maybe if you see unemployment tick up continuously for a few months, maybe then it's going to matter. But just this one single data point, it really doesn't matter. And it's a kind of this. We talked about this, I think, in the last call where we were talking about Nvidia and how Nvidia's earnings is now a global event that everyone pays attention to, and it's kind of become this news-driven thing wherein every single bit of news, as long as someone's hyping it up and promoting it, everyone's just paying attention. Like the Bitcoin ETFs, I'm very surprised to see that 6 7 months later it's still in the news.
Yeah.
And
Mhm.
the only reason it's in the news is because it's just getting promoted and promoted and promoted. So we were talking off camera about this. Does Bloomberg have a bias in terms of reporting? And maybe they do. If you know you're kind of trying to drive the headlines a certain way so that the others, like, I mean, it's all social media engineering. Like that's the reason we go on Twitter, because it's a sentiment check. And same with Bloomberg headlines, it's a sentiment check. You have a particular headline, if the market reacts a certain way, then you're going to see all the traders try to kind of push in that direction. So you never know. Maybe they are kind of, and with oil especially, maybe they are kind of doing that, which is what we're talking about. So
Yeah, no, we
Yeah.
were talking about that a little bit earlier, which is we just don't know. And it's interesting. And Kevin brought up a good point earlier when we were off mic and talking about it. And I was talking about the fact that Bloomberg was running a lot of articles that were kind of opposing what OPEC was actually saying. And what Kevin brought up was a good point and a good thing to kind of talk about generally in media, which is when you have one person write something, the next person will write something, the next person. I mean, there's always I don't know if you guys have ever seen this video. I'm sure somebody out here has. And if you have, leave it in the comments because I'd love to hear about it. But there's a video about media, and that's been online for years. And it's like it says the same thing over and over again on like different networks. Today was a
Yeah.
beautiful day. And it just keeps saying that's the same thing on every
Was that
single
Sinclair?
network.
That was the
Yes.
Sinclair. Yeah.
Yep. And it keeps saying it on every single network over and over and over again. And that's kind of like what it is. It's not that it's as nefarious as people believe. It's just the way, like, think about most, if you're putting out reports in general, like you're going to read the news from somewhere, you're going to put out something similar, you're going to do that over and over again. Good research is mainly the idea of taking many different sources, many different things, finding your own research and digging through it and finding something a little bit different than what everybody else is saying. But once again, not everybody's putting out good research. Those big companies, what their job is to put out stuff over and over again constantly. So they're putting out new stuff every single day, getting people hyped. Like it would be a lot cooler coming on in, and Kevin and I have talked about this before. Same with Kashyap. We'd be a lot cooler if we came on here every day and said 50 new trades that you could put on, and people would be all excited about it. But you'll never make money like that. So we're trying to kind of be that middle ground of like, hey, this is what real trading is. This is how we're actually doing, taking the time to do good research, put it out in a timely fashion. But at the same time, we're not just putting out crap to put out crap. But so you have to just understand that a lot of those people are kind of just putting out similar things over and over again. It's not exactly nefarious, but choose your sources wisely.
I am not going to comment on any news organization because I work for one. So let's just say that we don't do any of that. So let's just say, look, I think you guys are right in a sense, right? you have this domino effect, especially when it happens with breaking news. And we talk about OPEC offline, right? Like that was a really good example where we had the initial headline and then we had another headline that kind of changed the narrative, and then all of this other stuff. And until you can go through, read the reports, until you can go through, read the statements, that you have to kind of rely on those individuals. And so I'm always a very big proponent, just in general, right? Like if you're a trader or an investor, especially on FinTwit. FinTwit for me is like it's a cesspool of just nonsense, and then there's bright spots and really good follows that just they're going to tell you how it is. They're going to keep it real with you, whether good, bad, or indifferent. They might miss a call or something like that, and you got to think about it. You know, like no one is ever 100% correct in this market. We have to remember that. Mm-hmm. But there's a lot of times, as you kind of talked about, this pushing of trades, like, oh yeah, like we there, you know, there's people, and unfortunately, like interact with some of these individuals on a day-by-day basis, that they all they do is talk about their winners, never about their losers. You would think that they were never losing in this market, and they were the oracle of trading. Let me just say this: if you're the oracle of trading, and nothing against it, but if you're the oracle of trading, you wouldn't be selling a subscription. You would be on a beach somewhere.
Yeah, making every right trade.
You'd be working and making 30% off profits for some hedge fund that's willing to give you billions of dollars to manage, not trying to sell Discord subs, right? Like that's that, and nothing against that. I'm not hating on that, right? Because the decentralizing and the democratizing of trading, I think, is a wonderful thing. But you got to follow a bull. You got to follow a bear. You get yourself a technician, a couple of technicians that are really good, that may have a skewed bias on the bullish bear side. Get you a good fundamental analyst on your, follow all of them. And then you aggregate that data together. And then whatever data points that kind of align up or overlap is what you really should be valuing. And those that disconnect, then you add more scrutiny and then you do your own due diligence and research. That's the right way to go. You don't go and just follow all permabulls who are just trying, selling you all of these. There are some individuals, unfortunately, that do have mass followings, and how they're able to perform so well is that they can, especially for trading options, front run their base, right? And they can call it
out. Off mic, I have a great story for you. I got to remember that.
They'll call it out. Oh yeah, look at this. We were buying the blah, 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 blah calls, doing it. We're 0 DTE. We're rolling it. Boom. They already placed their trades. And then now, 3,000 subscribers that are like diehards willing to jump off a cliff for these people will go in and say, yeah, we're going to do the same thing. And there's just domino effect. And then you hear, yep, I'm already up 50% on my options. And it's like, yeah, no doubt. Because you just push 2,000, 3,000 orders on the flow, right? And if you see a spike in order flow, what's market makers going to do? Raise premiums. Like it's real easy to do that.
Yeah.
Just kind of going back, get the data from multiple sources. For me, I am not a fan of Fox News politically. I'm just not a fan of them. I can tell you, I watch Fox News more than I watch the stuff that I actually politically lean with, because it's always good to get the other side's, opinions or perspective on something and be able to gain an opinion, even though I might not agree with them. Honestly, I probably do watch them probably just as much, if not more, just because it's good to see. You get stories that you may not see in other networks because of biases and things of that nature.
I love that comment. That's great. And no, man, you nailed that. And that's true. I really enjoy the idea. One, if you want to pick somebody to follow, one, they should match your time frame. Two, like Kevin said, have two different people. Like I'll watch people get mad at somebody like me, for example. I'm very long term. You'll have somebody try to be a day trader in my group, and they'll be like, "Dude, your trade sucks." And it's like, well, yeah, I don't trade in a day-to-day time frame. It doesn't make any sense, that because the thing is like, and Kevin and I just talked about this last week. If you have a time frame like mine, and you're running these, 6 months to a year trades, and you're in these trades, the volatility level is going to be so different. So for example, I'm running a let's say just something on the bonds, since we're talking about bonds earlier. Let's say I'm long bonds. My stop's going to be 10% probably. If you're a day trader, a 1% move in a day for a bond is pretty huge. It does happen, but it's rare. So your stop could be 1%. And so you just have to have people that match your time frame. And once you do that, then get a diverse group of people, different types of people. But you also have to align with and respect their ideas in some form of way to really follow and learn something from these people. And you can grasp a lot from people on a very long-term time frame. I'll watch day traders talk about how they don't learn anything from a long-term time frame, and it's like, well, if you understand the primary trends and general action of the entire market, and then you can be on the side of those primary trends, you're going to make a lot more money than somebody who's just trying to, buy and sell every single thing that hits a level all the time. But I really like the way you put that, and I hope a lot of people grabbed onto that one, because I think the idea of one, it's news. There's so many different places where people can go. And then there's some networks, like you work for a network that does good work. Like there's some networks that just do good work, and they're not trying to sell you on, the idea of taking a trade every single day, or a new day trade, or hey, I got a signal service. I mean, if you guys, Kashyap and I lived through all the crypto cycles, so seeing all the crypto cycles, because Kashyap and I have been in crypto for a long time. Living through all the crypto cycles, we've seen every single signal service ever, probably. Like all of these people putting out, and they'd make a ton of money for, a year, and then they would disappear, and they make a ton of money for a year and they disappear. So just be careful with stuff like that as a trader. That's really important.
And especially you should avoid the guys who say this is going to be the next Nvidia, this is going to be the next Bitcoin. Anyone who promotes that, chances are they're lying to their teeth.
Coffee is going to be the next cocoa.
Maybe. Yeah, let's talk about some markets, man. We able to get let's get some commodities up, like especially with the commodity moves today. Like here, copper. Copper is a good one, right? I mean,
broke a major level today.
450, bro. 450. We've been talking about that. So it broke. What I'm concerned about is I'm not seeing a bounce at 450 either. No. That's concerning. Now 465.
Well, we did. Now we're not.
Yeah. Short-lived, right? Very short-lived. So we have 465 as an area of support from a technical standpoint. That was kind of the highs that we've seen, where we consolidated before we broke to the upside, hitting about $5.20. So that was actually the technical support. I was thinking 450 because what futures traders love, round numbers, even numbers. Just seems like now we're breaking through that on an intraday basis, and let's see where we close at. But not a really good sign. I still think that there's unwinding of the speculators that are out there. We kind of I've been harping on this for the last couple of weeks now, actually literally the whole month of May. Supply's hitting the market, guys. Like, so physical supply is going to hit the market this year this month out of Indonesia. Like, that's going to happen. And so is that going to readjust or reposition the producers, right? And if the producers, which haven't been following any of the speculator flows over the last 4 weeks, I'm not saying they're giving up, but the producers aren't going to layer into something that they know they can't deliver. Like that's a proposition for failure. Or if they're not seeing the right demand out there, they're not going to get in there. So speculators were creating that churn past that $5 level. We are seeing that pull back here a little bit. 450 was kind of my area of support that I was kind of looking for. If we break through this, I'll have to do more research over the weekend. You know me, I nerd out over the weekend, and then we kind of do the market report, the commodity report on Monday. So we'll see if there's any other technical levels that can be able to hold. Looks like 446 could be one. That's kind of a lower wick that we saw. When do we see this lower wick? Lower wick that we saw on May 2nd. So maybe that could be a thing. But if you just bring up the daily chart and you see this candle, this thing is an engulfing candle. It's not just engulfing yesterday. This thing is an engulfing candle that's literally engulfing the whole week's trading action. And that's significant for bears in this market. That's going to try to potentially capitalize and try to get some of these speculators out. What do you guys think? Kashyap, what do you think, man?
Yeah, so I look at it on a fundamental basis, and what I saw was that whole move over $5. So it was a short squeeze. And there were a couple of reasons for that short squeeze. One is the US abruptly banned a few of the Russian metals. So they couldn't be delivered against the contracts. So what happened was, so the thing with copper or any of these major commodities is you have these physical traders who buy or sell the physical, but they hedge with the futures. And the problem was they had all hedged with this particular contract, the July futures contract. And so they were short. And Trafigura was one of the big ones which was short. And what they had to do was they had to figure out how to kind of handle the situation for themselves. And once they did, the short squeeze ended, open interest fell off a cliff, and that's it. The trade just, it's over. So the beauty with technicals is I think you will be right at finding the level at which it bottoms, but as a trader, what I would be looking for is, okay, sure, it's bottomed and it's, perfectly retraced to this level, it's bottomed here. But what happens then? Is it going to go into a trading range, which I think is most likely right now, or is it going to have a further move? And I think it just goes into a trading range because the price is sufficiently high to incentivize all sorts of supply to come onto the market, especially the Chinese supply. So we had this big news of the treatment charge, the refining charge was going down to zero in China because they were just trying to get as much concentrate as they could. And then they did get as much concentrate as they could, but and now you have this Evergrande blowing up, you have this huge real estate mess there. And so chances are that side is done. And with higher prices, of course, you're going to get more production coming out of Brazil, or maybe not. So that's something that we will be talking about soon. So you're going to get more production coming out of the producers in terms of whether it's just forward sales or in terms of whether it's actual mine supply. It's the higher price is just going to incentivize everyone to just come out and flood the market. And
Right.
especially they don't do it on the way up, because on the way up everyone is waiting to sell the top. On the way down everyone is going to panic and just lock in the price because they know it's over. So I think we are going to get the big flood of supply now that the price is on its way down. So it's going to be interesting to see. But yeah, that's how I'm looking at it.
And those big producers too, once it hits these key levels, they were selling those flows to these speculators. And like you're talking about, once it hit $5, the producers were like nowhere to be found. If you're looking at the commitment of traders report, they kind of just stalled out. And in fact, they started taking net positions off, right? Even going, because sometimes when you have these rapid moves to the upside, producers may actually go long the contract in the event that they're not able to cover real quick on a physical demand standpoint. But you saw them kind of layering out once it hit $5. Speculators were partying. You saw the volatility spikes. We saw these blow off top candles happening. And that's kind of where we're at right now. The other thing to kind of keep in mind, if you're looking at the futures curve, for those that are following the futures curve, we're looking at the further dated contracts compared to what the front month is doing right now. Just know that you are seeing a backwardation between the July contract and August. Do not focus on August because it's not a liquid contract at all. Actually, in fact, I think it's only traded like 180 contracts today, if I'm not mistaken. So you want to look at the September contract, and the September contract, for the most part, compared to July, is trading even. And now we're in this we're in this contango curve, this normalized curve. Future contracts pricing higher than the front month contracts. And that was something that we did not see 3 weeks ago, 4 weeks ago, when the curve, for the most part, because of the rally that we've seen, was pretty much flattened out. That flattening rally has now turned into a normalized curve, which, once again, accounts for storage costs, it accounts for time, it accounts for interest, all that stuff, right? So the market now, by looking at the curve, is not concerned by supply shocks. That doesn't mean that this whole thing's going to reverse down and it trades down at $3 again, or in the near term. But that just means that we might have seen a sufficient level of speculation compared to what physical demand is going to be. You're right about the blockade when it comes to Russia and things of that nature. But Indonesia is now going to allow a significant amount of copper hitting the markets, 900,000 tons, if I'm not mistaken, coming out of Indonesia starting here in June. And for China, they've looked at recycled copper, right? So you can get copper and smelt copper through the actual ore itself, right? Or you can get recycled copper and smelt that and utilize it for whatever. China's been doing that last month and the month before that. That's really how they've been trying to backfill some of these supply shortages. And I'm not going to say it's going to be the most sustainable long-term type of trend, but it's something that's worked for them in the immediate term to be able to relieve some of that pressure within the ore market. And I think that's also another reason or another catalyst why we're kind of seeing this little bit of a pullback. Jason, what do you think?
No, I like that because that's the news flow that I've been seeing too, is the China part. So look at this. If you just think about it this way, and there's a couple different things we all picked up here. If I just dissect what you guys have all talked about, so there's the fundamental angle of it. The fundamental angle of it is where it's sufficient levels of price, which is very, very normal. We're also seeing, if we're looking at the COT reports here, I mean, Kevin and I talked about this a couple of weeks ago, but you get this type of a spread between the speculators and the commercials, and we're into possibly a top of something. The runs don't last forever, and not to mention things need to consolidate to run again. That was a huge run in the copper complex. That's a huge run. It's something that you just don't see much that quickly. Massive move. Broke out to new highs and then kind of just chopped around. Very normal movement in commodities. Also, the thing about levels with commodities, that's also something to think about. Commodities overshoot and undershoot. So when we're looking at levels, and it's a thing like any old school technician will tell you, support and resistance should be used with or drawn with a marker, not a pen. And the reason why they say that is because it should be wide. If we're talking about 450, you should be looking all the way to probably 440. Because especially with the commodities complex, it's going to move way past the support zone most of the time, way past the resistance. And it's the same reason why, people probably thought, hey, copper is going to get up to these old highs and it's going to stop, and it blasts right past it, and then it comes back. If you look at what they call that in technical analysis is a throwover. And if you look at gold when gold made its first all-time high again a few years ago, if you look at copper recently, you see these throwovers again and again and again where we hit these new highs and then we come back and consolidate. I do think copper is in a point where it's just going to consolidate here. I do think that makes the most sense for this trade and the environment we're in. I think if we start to see it really break down in a major fashion and continue lower and lower and lower, we're seeing something else building here. And that's something, Kashyap and I talked about this last week, and I think Kevin and I talked about it a little bit, where it was like, hey, the market isn't looking perfect these days. It's not clear skies ahead, basically. We're seeing some reasons to be a little bit cautious here. If we're looking at something like copper coming down and oil coming down, that's usually telling us we're moving into a different type of environment. That environment, though, could kickstart the commodity cycle. And that's part of the reason why I think gold is doing what it's doing, and some of these things are kind of showing it, is that we're going to see the commodities run at some point. I just don't know when exactly. Go ahead, Kevin. Kevin knows exactly when.
I'm gonna kick it back over to you. So gold is not moving down because there's probably a little bit of it because of the NFP report, right? That's not the main driver. Gold's moving down because China did not buy any gold last month. And that's the first time that they've not bought any gold for their reserves in a very long time. Now, that I think that's the reason why you're seeing because they were the major physical buyers out there getting it, right? China, Russia, India, even India kind of slowed down a little bit. Now, I think that's another reason for the sell-off in gold. But be mindful, as prices go up, do you think central banks are going to continue to buy? Central banks are traders as well. So when prices hit extremes, they might hold off. There's a notion, and I don't think it's the right notion, that China's just done buying gold. That's not the case. I think China wants to see gold prices start to come down a little bit, and then they're going to continue
to a level that makes sense.
Exactly. But that was actually the major headline overnight, was the central bank buying activity from China and the lack of buying of spot gold for the month of May. And I think that's once again, we had the NFP move, of course, but I think that's going to be more of your fundamental catalyst driver moving forward over the next couple of days, rather than what happened in non-farm payrolls. And I might be wrong.
No, that makes sense. And that's my main point about bringing up gold, is kind of the general trend. So when we're looking at it, I should be more succinct when I say that. So when we're looking at it, seeing these new highs that happened this year in March and into April and, ended mid-April, you're basically seeing that major move saying that the commodity cycle is going to start at some point. Most of the time when we have those big breakouts, we see the rest of the commodities complex follow, 6 months to a year and a half later. But sometimes it also gives those types of signals and then comes back. So basically saying we'll see this big move in gold, and then we'll see some sort of catalyst. A catalyst meaning, all of a sudden oil starts to drop off. All of a sudden copper, let's say copper doesn't stop here. Let's say we're completely wrong about the support zone. Let's say we're completely wrong about a range. And this is why it's important to mark all this stuff off as a trader. Like, most likely, yeah, like it's in an uptrend. Things range usually when they go into uptrends, and then they go higher. But it's good to mark that off and go, okay, if we break under these levels that we're talking about here, like let's say we break 440, we break 430 in copper. Let's say oil just continues to break lower and makes a new low, which it hasn't made a new low in... God, it hasn't made a new low since
8 months.
8 months. It's been a long time since we've seen that major low that happened in 2023 was really the last one, and that was in May. Looks like May 2023. So let's say we start to break those levels and we start to hit 60 in oil, and then in copper, same thing. We start to break down. We continue to make new lows. That's going to tell you that this market is heading into a very different environment. And that environment's going to probably be pretty nasty. It's going to tell you that the Kashyap might be wrong about right about the bond move today, meaning maybe the market report spooked everybody, and maybe the bond market still moves back to the upside. If that all happens, let's say the bond market moves to the upside this week, and then oil continues to move to the downside, and copper moves to the downside, you're probably looking at a pretty nasty market environment incoming. And for now, I don't have that view. I'm not seeing that yet, but that's what I'd be looking for. And that's why I'm just mainly bringing that up to say the importance of these levels that we're talking about. Because if oil starts to hit 60, if silver starts to actually break down, let's say it gets back to 22, like we start to see 22 back on silver, that'd be insane, and let's say copper starts to break these levels and gets under 430. Like for me, that would be, a big catalyst telling me that the market is moving the other direction. So basically what I'm trying to say here is that these moves need to start holding up at these zones. Copper would need to start holding up. Oil would need to start holding up. And then I would go, okay, well, this all has more upside. The commodity rally is still intact. We'll still see some things moving up across the board. For me and just my positions, just to talk about what I have going on in copper. Copper, my trailing stop is it's come back about 11% already since our move. My trailing stop is I think it's about 17% right now, so it's right under there. A 50-day low is way below that, so most likely it'd be getting out of if it doesn't start chopping around, I'm going to get out with my trailing stop, which I don't like to do, but that happens at times. But copper basically is looking like it's pulling back. I think the overall thesis and what we're all kind of thinking here is most likely consolidation, but I'm just kind of paying attention to see if it holds those levels that we're all talking about.
So, Jason, I'm going to send you a chart. Kashyap, by all means, I just wanted to let you know.
Sure.
I'm going to send you something over.
Yeah. So
I also see Kashyap sent me something too, so I'll get that from Kevin, and then Kashyap, if you want to talk about your share here.
Yeah, so this is the July-September calendar spread in copper, and you can see that huge move down where it went extremely negative and it just kept going. So this is just something I clipped when I was looking at it, and it just kept going. I think it hit 24 cents or something, and that was the blow off top in copper in the July copper contract. And so when you have a move of this sort, you're definitely going to see a lot of open interest come off in the front month contract, and you're going to see a lot of it flow to the back month contracts. And you're also going to see all the traders who pretty much made good money on the way up, they are done, they are out. And all the physical traders who are mostly caught on the wrong side of this, they are just going to continue with business as usual, because for us what we see is a huge move and a consolidation. What they see is something happened in one particular contract in one particular trade, and they just wipe off the loss and they move on and they go about their business. So this is what I'm seeing, which is why I really think whatever happens to copper, like I like the point about how you do technical analysis looking at a zone. So if it's 4.4, then 4.3 is fine. If 4.3 is fine, maybe 4.29 is fine. And I think that zone has got to be really wide for copper right now, mainly because of the way the move happened. I think you just have to be prepared for a lot of chop and not get scared of seeing what's happening or reading just too much into it. Now, maybe if this continues for another 3 or 4 months or even 2 months, then I might be a little more cautious. But right now, I would just ignore the volatility in copper and just consider that whatever's happened is just normal, the market working off its excess.
Yeah, and Kashyap, you're bringing up a really
I
good
agree
point
with that
too.
too.
We're,
Yeah.
we're coming up to the exam. We're exactly what you're kind of talking about. That's also kind of going to the base case that the $5.20 level was an accurate fair market value for this contract, and probably was not. Right? I mean, when you have those speculators getting in, they disconnected the price of copper to spot markets, and so we are kind of seeing that equilibrium coming back, and I think that's a good thing to be able to see now. When you're looking at copper, what could be concerning is if it does hit $3.96, that would be the 200-week moving average. I've only seen one time where we've seen super aggressive selling over a matter of a month and a half where we had this type of move, and that was actually in May of 2022, where we just had like this blow off top type of scenario. But what was different with that, and we kind of talked about this, Jason, a couple of weeks ago, copper tends to try to triple top. We rarely see triple tops in anything that you trade, but copper typically triple tops before it actually makes a fundamental shift in price action. Let's see if that's going to be the case this time around. But if not, then we're hitting that 200-week moving average. But once again, it's hard to make it an economic indicator if you're using your base case of $5.10, $5.05 as the real market going rate, and then having it sell off and trying to extrapolate that that's a signal of economic slowing. At this point, what would be a sign of economic slowing is if you see a fade from recent consolidation areas in copper. That would be your telltale sign that something's actually slowing, right? Where people had perceived value in the past, but no longer see perceived value. And you see areas of value in consolidation trends, not in breakout to the upside type trends like we saw with copper recently, right?
No, I like that, and I completely agree with your assessment of the range. And oh, wrong chart. Sorry, I was gonna bring up Kevin's chart in a second, but yeah, I completely agree with the idea of the range. And what I wanted to just show everybody is what we're talking about. Oh, of course, I get to exactly 100 here, and it's like right when I'm trying to put that up. Okay, 1 second. Sorry, guys, I don't have room on the StreamYard, I guess. So basically, I just wanted to illustrate what we were all talking about. So what I'm talking about is if you're looking at a very long-term angle,
yeah,
and you're going, okay, so long-term angle, where would this catch support? and it would be this zone, but then you draw it very wide. Now, this is helpful for trading because of a couple things. Now, people think when they're buying things and it's hitting support, that's when you buy things. That's not it. You want to wait till there's some momentum behind it. You can use a 10-day moving average, just to get some momentum underneath it, but you want to see a little bit of a move up before you buy something that's just crashing into support. So what I would do is look at this major level. If you didn't have a position, and I'd go, okay, well, I'm going to wait for this to dip into this major level. Maybe it's up near the top. Maybe it's all the way near the bottom. I don't know. And then you'd wait for it to get, up and over that 10-period moving average, and you would be incredibly surprised how profitable it is just to wait for that above just buying at support. So you do that. That would be one way to look at this. And also that level, why I'm drawing it so wide in here is this is where the most open interest will be, the most volume per se, because this is where the most price action is. So basically you take an area where you see where the prices hit the most, and that would be the biggest area where you'll most likely see buyers kind of come in there. And below that's the red line. The red line, it's kind of hard to see, but that's the 200-week moving average that Kevin was talking about. That is all the way at, let me get an exact number for you guys. Can't see it on the screen, but I still have the chart up here. So that's at $3.98. So $4 basically, so $4 being the most most major support there for copper to say it's possibly still in an uptrend. We're pretty far from that. So I would think, our assessment here is right. We see it kind of pull back. We see it hit these zones. We see it consolidate, move sideways, and then possibly move higher. So Kevin, you also brought up another chart, a really good one, which was the oil chart, and I really like that. I like working with you because you're like me, because we're talking, you're like, oh, and you remember something like that. So let me pull that up here. I had to delete it.
I think that's called ADD.
for sure. There's a bunch of names for
which is all good.
It depends on who you ask. You ask my mother, it's one name. You ask my fiance, it's another name. Neither are probably very nice. So here we go. So here's Kevin's oil chart. So I really like this chart. Go ahead, Kevin.
Yeah, so this is a 10-year time frame, and look, the only reason why I did 10 years is because you can actually kind of see it. If I did a 20-year, it gets a little bit it's harder to see. 200-week moving average, I won't belabor the point. Huge when you're looking at pretty much almost any commodity, but especially when you're talking about crude. It is a economic indicator for me when we break below that 200-week moving average. We actually did that earlier this week. We are trading still below it fractionally right now. But here's the reason why I kind of bring it up. I wish I took that channel off. But the reason why I bring it up, we usually do not knife through the 200-week moving average. And when we do, it's because of a major event like COVID-19. You can kind of see that on the chart there. We just knife through it, and it's not rightfully so, right? But if you kind of notice this, the 200-week moving average is a really good area of support. And this is not a trade recommendation at all. Do not follow it's not a trade recommendation. But if you kind of go back, when we touch the 200-day and you're looking for intraday swings, or not intraday swings, but swing trades, maybe a couple of days, maybe a week, maybe 2 weeks, you can actually see that we actually have pretty decent bounces off that 200-week moving average. Typically, we see that for about a span of, let's say, 4 weeks, 5 weeks. Sometimes, in some instances, we see it more than that. You can kind of see that going back in 2019, May of 2019, we kind of just continue to bounce off of that. So we want to be able to hold that, obviously. But if you're looking for a tactical area to try to trade around, the 200-week can do that. Just be mindful that if we do break, we can break significantly. And so you want to have tight stops if you're trading the physical contract. If you're using futures options, you can't really have stops on those at all. So you got to really kind of watch those. But that's kind of what I'm looking at right now. I think we start the trading range or the consolidation where we bounce. Maybe have 2 days where we see some green shoots, then we fade again, hitting the 200-week, that we see some green shoots. And maybe these moves, Jason, may only be $1, right? They may only be $1.50. But when you're talking about only $1.50 on one contract, that's $1,500, right? So that's what I wanted to kind of highlight, just because the primary trend that we've seen this year has faded doesn't mean that there's some tactical trade opportunities within crude. It's just going to be more of a choppy, range-bound market, most likely, rather than a complete knife to the downside, unless we get some significant economic data that shows slowing. And today's NFP report, a non-farm payroll report, is not the type of report that's going to break this thing to the downside. Still showing growth on economic data points like labor in some respects is actually decent and good and productive for commodities, right? Because you're still having the economic cycle in some areas still showing relative strength. The curveball with this whole thing is going to be inventory levels, right? And those continue to build up, especially when you're looking at gasoline. Refining rates are starting to ramp up at a very rapid clip. Let's see if they pull those back. If they constrain supply a little bit, that's going to start firm up price action. But I wanted to bring that chart up just to look at the trends. Usually we don't knife through the 200 week. We usually don't do it for too long. If we do break down, it's most likely an economic event that's going to drive that type of scenario.
No, for sure.
That's a really good point.
Ahead.
So the other thing that just struck me when I was looking at the chart was, you're right. So we are not going to knife through that and just stay there. But let's say we do, then we get a bid from the SPR, because they have been itching to refill those reserves, and oil below $80. Let's say we get oil to $70. I think somewhere along the way, the US government is just going to put a floor on the oil price and say, this is the price at which we refill the SPR. And I mean, just thinking out loud, it's kind of just hilarious that Biden might probably be going out as the best oil trader in the entire presidential history, right? So 2022, he got gasoline down. 2024, he is getting gasoline down. Now, if he succeeds in refilling the SPR, then that's literally the greatest trade ever.
That's a good point. And, I think it's oil is going to be an interesting one. And I think another thing from Kevin's chart that we could talk about too is what you see a lot about the moving averages, because too many people, it's the same way as the resistance thing we were just talking about. Too many people look at it and go, oh, we broke it. It's the end of everything. For me, if it's a weekly chart, I want to see what the close is. If it closes today around that 200 and then gaps above it for, Monday next week, that's going to possibly tell me that the uptrend might resume in oil soon. So it's the same thing. If you look back, you can see all these doji candles or these big wicks on these candles, meaning that you have, the breakdown, and then it gets bought up right under the 200-week moving average. And this continues to happen. I mean, it happened a lot. I remember, what was that? 2019 was the year. Oh yeah, it's back here. The chart goes back there too. So 2019, you see these breakdowns too. We get right back above it. 2023, we see those breakdowns. We get back above it twice. Now we're doing it again. Now, one thing to keep in mind, when you see something hit an area many times or a moving average many times, the probability of it breaking through that area goes up. Now, even though I have a bullish view on oil going forward in the long run, I'm not going to just say that's not true and just go, hey, it's all good. I think we're going to bounce here. I think, once again, everything's always dependent. You got to sit on it, especially technical analysis. Technical analysis doesn't work for a lot of people because they use it in a way that's so objective and not subjective. And really what you have to do is you hit that zone here. Like I said, we have a gap up on Monday. We start to get above that zone. We clear, let's say 80, that would generate a buy signal. That would say we could resume an uptrend. Buying things, when they're just falling and crashing, that's just a way to lose money, especially in the commodity space. Commodities, they love to, you get a down day, you get another. People are like, why is there 5 or 6 down days? It never happens in equities. Well, if you back test that, yes, like in equities, 4 down days, the next day, if it's an up day, you can buy that 78% of the time you make money. I mean, it's a crazy high win rate. But if you do the same thing in commodities, you never make money. Actually, I think it was like a 10%. I posted this not too long ago, but it was like a 10% win rate or something. So, commodities moving down and trying to buy them at zones is tough. But what you're looking at here is, okay, we're at this 200-day moving average. Let's say we gap out of here Monday. We start to get above that high from last week, which was let me say the exact number so I'm not just saying words here. We get past that other high, which was at 77, and we start to break above that zones from this week. So basically, we have a full reversal from this week's candle. We get above it. You could take a short-term trade, putting a stop at 72, taking your buy signal at 77, and try to trade it up to 85. Like that. That's what you would do as a technician, but you wouldn't just buy it because it's hitting a 200-day. So what Kevin's talking about here is incredibly important and something that everybody can kind of pay attention to take a trade on oil in the market or see if, and oil is everything. So if you know where oil's going, you know where rates are going, you know where equities are going, or where you want to be positioned in equities at least. So, what Kevin's brought up here is a way to kind of gauge exactly where that's at, see if it closes above that 200 or if it doesn't.
Yeah. Like I said, they would be like a dollar. So the resistance area that I'm seeing right now, short term, very short term, right? Next week, 2 weeks. Resistance area is 78 and some change. Let me confirm that. I think it's 78. I was looking at it last night. Yeah, 78 would be that resistance area. So these would be chop trades that you're just scalping, right? This wouldn't be one of those like you get in and then you're holding it until it hits 85. This would be, it's trading at 75 right now. Thing hits 77, sell it. Goes back, hits the 200-day moving average or 200-week moving average again. Maybe you get in, nibble, scalp another 80 cents, $1, and things of that nature. It wouldn't be a major shift or like a trend shift type of trade right now, in my opinion, until you start seeing the byproducts start to outperform and completely reverse and basically have bigger gains on a daily basis than crude. That's when you know that you're going to see, that's like the beginning signs of a paradigm shift when it comes to crude, right? We're just not seeing that right now. We're still seeing a lot of weakness, especially when you're looking at heating oil. Somebody was asking about, you guys still want to talk about crude? I do have a jet in about 10 minutes.
Yeah, I just want to talk about crude for another second because my main point isn't to say what my view is on that. It's to say if you are taking a trade in something, for example, like I will have no trade on oil until it clears probably a major level much higher than all of those things. But if you're a trader and you're trying to buy support zones, you're trying to buy off of moving averages, that's how you would do it. So that's what I'm kind of putting out into the air. Because I think too many people, they hear us talk about things like that and why the 200 days is important. And it's not that, Kevin's not going to buy like crazy at the 200 unless he's looking for maybe a short-term day trade, scalp bounce thing. I'm not going to just buy at the 200-day moving average. I need to see some momentum behind it. So just technically wise, if you're looking at support zones, you're looking at moving average support and so on. You want to wait till you have some momentum behind the move. So that's what I was mainly bringing up.
Want to hit silver?
Yeah, let's do it.
All right, so silver, kind of like copper, seeing a little bit of a fade in the market right now. Look, they're two different products, and we kind of get towards the conversation again of when you have one metal moving because of actual fundamental thesis, that's actually a really big thesis, right? Supply chain being a little bit disrupted. Takes a long time to get mines online when you're talking about copper. But silver, in a sense, may have a little bit of supply constraints, but I don't think it's as aggressive as copper is. And maybe Kashyap has some other fundamental data that says otherwise there. We kind of go back, and when we initially talked about silver and the potential breakout, this was, a couple of months ago, right? had to be March, I think, when we first started doing these on a weekly basis. Talking about utilizing the precious metal not only for the reflation trade, which in my opinion, the reflation trade right now it's fading, it's consolidating, it's giving back a little bit.
Oh, for sure.
But it's silver is an industrial metal hedge as well as the inflation hedge just in general, right? So if you have industrial production metrics continuing to rise on a global basis, especially coming out of the Asia Pacific, and we were talking about China, the reopening happening there. Japan, even though it's a kind of a smaller market when you're looking at manufacturing services, still there's a huge electronics base that's still there. If you're talking about Singapore, if you're talking about Taiwan, right? Taiwan semi, all of those electronics, like 90% of electronics use silver in some form, in some fashion, right? If we continue to see that type of growth, that gives you the fundamental thesis, but I think it has run up a little bit too much too fast. And I think seeing the deflation in prices when you're looking at energy, I think is also kind of hinting to the fact that the reflation trade's fading here a little bit. Silver, I think, was a little bit overdone. I have been looking at silver trying to hit back to the 25.50 level. I don't know if we're going to get there anytime soon, right? I might want to kind of like move that bad boy up, but 25.50 seems to be a decent area. And the reason why, if you kind of once again bring up a weekly chart, I'm not asking you to do it, but just those that are looking, we had this wedge pattern. Okay, we had this wedge pattern that has been that was actually in place since March of 2022, and we had relatively higher lows, and we for the most part had leveling out when it came to the highs, right? You're sitting at around, let's say, $25.50, $26, which is why 25.50 was a key area for me looking at it. We had that breakout, strong breakout. What you want to be able to see is kind of a retest. The first retest is going to be 27.41 on silver. If we have a retest and break back to the upside, I think that could be, a setup there. If we break that 27.41-ish area, then once again, I would look at 25. But I think the move has just gotten too far, too fast. It's different than gold. Gold has a little bit more staying power when you're looking at central banks really gobbling those up and buying those out. Yeah, perfect. Yeah, we're always aligned, man. Look at that. This guy's got it. So yeah,
I didn't edit it at all either.
Yeah, looking at that top right, looking at that zone, he's got it in green. That would be your 27-ish area. That zone would be your first test. You break through that, then that middle zone that you kind of see from those lows, which is around that $25 level. Look, I like the breakout of silver. I miss it. I miss silver. You know why? And when I say I miss it, not miss the move. I miss silver when it was just a boring, range-bound, technical beast of a contract that you could just, it's hitting the support area, buy. It's hitting a resistance, sell. Support, but I mean, this thing was trading on technicals for a very long time, and it generally does. The breakout trend is nice to be able to see. Maybe it goes back to trading in those technical ranges again, but it was a contract that was, I don't want to say an easy pickup, right? But it was something that was fairly reliable when it came to upper resistance zones, lower resistance zones, following pennant patterns, following these, asymmetric triangles, these descending triangles, whatever. It was really good doing that. We had that breakout. I'm a little bit of a hater on the breakout only because I kind of miss that range-bound action, similar to what utilities used to do too. Utilities used to be a fun one because it's just like a scalping machine until it's not. And so that's what I wanted to kind of highlight on that silver portion there. 27.41, 25.50.
And I do not miss it because I'm a trend trader. So
yes, this is your bread and butter. This is where you're
what I do well. The range stuff is what drives me crazy because then I'm just getting chopped to death. So it's like but that's a good thing about having like different views, different time frames. Like you can understand where everybody's coming from, where there's a good time to buy for someone like Kevin might not be the same time to buy like me. And so on. And so we always I think we do a pretty good job of always trying to explain things like that, because I think it's hard to grasp that just in the general conversation. So we try to explain those things as well as we can. So, all right, guys, I think I'm going to end it there. I'm going to get some food and go do some work. Got another report today, and Kevin and I will be on Monday. and Kashyap will be on with me on Friday every week. So both times, usually at 11 a.m. or 12 a.m. On Mondays and Fridays. So join us, guys. We'll see you then. Got a bunch of great new videos on the YouTube right now too, with a systematic crypto trader named Pavel. Great guy. So all right, guys.
I like that video, by the way. Very good video. That was pretty dope.
He's
Pretty
good
dope.
people, man. I really
Yeah,
like
he
that
is.
guy. So
Down to earth. Down
yeah,
to earth. Tells it like it is.
yeah. All right, guys.
Have a good weekend.
All right. See ya.